Hello there, and welcome to the Apartment Building Investing Podcast. I am your host, Michael Blanc. I'm super excited that you're here. Now, in this time, I'm putting out a very special episode because of what's going on with COVID-19 and the uncertainty, anxiety out there. So I wanted to kind of really address this head on of what's going on right there out now, what the outlook is. And to help me with that, I've assembled an incredible panel of experts. Between the six of us, we control about $1.5 billion of multifamily real estate. So you're going to get a very wide perspective. I got people like Brian Burke, Andrew Cushman, John Cohen, Reed Goosens, Drew Niffin, and Ellie Perlman. And it's going to be a really exciting episode because we're going to talk about what we're seeing right now and what we're doing about it. What are we doing to protect ourselves, to protect our investors? But what at the same time, what are we doing to maybe serve the tenants as well? What do we see in the future? What's coming up? What's happened to the capital markets right now? Are we maybe going to get some buying opportunities? And if so, how do you approach those buying opportunities? And we're going to get all that into that in this particular episode. Let's get right started with the episode. Welcome very much to the live streaming webinar with a panel of experts about how the sky is falling. Just kidding. Just kidding. It's just a catchy title to make you guys tune in. But I'm really, really excited to have this panel of experts on this call. We have some considerable firepower across tens of thousands of units. And so what we want to talk about today is how this whole thing is affecting us and our investors. And therefore, you can, if you are owners of multifamily buildings or even other commercial property, you might glean on some tactics that we're doing to try to protect ourselves from what we think might happen. And also, if you're a passive investor, you can see what some of the more experienced operators are doing to protect your investment as well. So I'm going to kind of go around the room here and introduce everybody here in no particular order. We have Drew Niffin. Drew, say hi to the peeps.
Hello, everybody.
Drew is president of our investment company called Nighthawk Equity, and we control about 1,700 units valued about $80 million. We have Brian Burke. Brian, say hello. Brian's been doing this longer than most of us, and he has owned, traded, and bought $500 million worth of property. He's also the author of The Hands-Off Investor, an insider's guide to investing in passive real estate in syndications. John Cohen, JC, say hello. John is no slouch either. He's also transacted about almost $500 million worth of real estate as well. Reed Goosen, say hello.
Hey, how's it going?
Reed's got a weird accent because he's from down under, and he's no slouch either. I don't know. I didn't ask you how much you control, but it's about 100 million or so.
Oh, it's a little bit more than that now, but we won't get into it.
Oh, you're just a snacker. You need to pick up the pace a little bit. And
we have, last 2 weeks.
We have Andrew Cushman here. I don't know how much you control, but several thousand units.
Yep, done about 1,800.
Oh, see, 1,800. Wow. Okay, you need to pick it up a little bit. And we have Ellie Perlman, founder and CEO of Blue Lake Capital. She controls about $100 million in real estate. And if I do some quick Excel spreadsheet math, this group here controls about almost $1.5 billion worth of real estate, which is really insane. So really, I'm doing this partly for my benefit and everyone watching, listening to this, because I want to learn from all you guys. We're kind of in this situation where many of us, even people like Brian, who's been around in the Middle Ages, have not really seen before, though maybe in flavors of it. And I value your feedback, Brian, because you've seen some flavors of this. So the stuff you're doing, I'm watching very carefully, but I also want to hear and see what everybody else is doing and share kind of what we're doing to what we anticipate might happen, how we're mitigating that possible risk, what our outlook is, and what we're doing to protect our investors' money. So let's, with no further any further ado, let's kind of get into the discussion here. Those are the things we want to talk about. Andrew, I'm going to call on you first.
All
Andrew
right.
Cushman, and then we'll see. We'll open it up here. But what are you doing as an owner to essentially protect your investment as well as that of your investors' investment? And then we'll go around the room, and I'm sure you'll knock off like 80% of what people are already thinking of. But if someone's doing something different or unique, then let's talk about that as well. So, Andrew, what are you guys doing?
Yeah, I'm telling you, I'm jealous about all these people that I see asking about what to binge on Netflix, because I've been working overtime the last 2 weeks. There's been no TV in my schedule, but we're doing a lot of things, and there's two main aspects. One is income preservation, and then expense reduction, right? And, and we're in a whole new environment now, whereas before we all had business models and plans of growth and everything. Now, number one is asset preservation. And part of asset preservation, of course, is capital preservation, especially for those who are syndicators. We have, other people's money involved. So we actually started about 2.5, 3 weeks ago. Putting together resources for not only our properties and our management. We use third-party property management, but we have an unusually close partnership with them. So we do work very closely. So we've been providing them flyers. In fact, what we did is we took our 2 acquisitions people and said, you are now asset protection people, and their main job is to go and look into the CARES Act and all these government programs and like, what can we do to apply to the property. So we've been sending flyers to our residents. Okay, here's how you apply for unemployment in your state. We did a survey. Okay, these 8 employers are actually hiring right now because they have increased demand. Here's the various charities in your area that are still going. And basically we've provided every resource we could find. We've provided that to our tenants. And again, we started this a couple of weeks ago to try to kind of get ahead of it. And then at the same time, we've been going through our P&Ls and saying, what can we cut? What can we reduce? I just got an email earlier today. One service provider agreed to cut their monthly bill from $1,500 to $750, right? So, times a year or whatever, that's a significant savings on the property. We are also going to be applying for the PPP, which I believe is the payroll protection program, which can cover payroll as long as you don't fire anybody. So that would be the on-site staff. There's some question as to whether or not that applies to apartment buildings, but all they can do is say no. So we're definitely going to apply and try to get it because it's very legitimate. We do want to obviously keep our people there and keep them paid. And then, we've been much more flexible with tenants than we normally would be. And everyone's heard about the eviction moratoriums, which candidly, to me, that's actually a negative because number one, we're not going to evict anyone right now anyway. I mean, if someone's in trouble because of COVID-19 and that's to me, it wouldn't be moral to evict them. 2, if you did evict them, there's not going to be anyone to replace them, right? So we're not going to evict anyone. But the danger that I'm seeing is with all of this, everyone promoting, like the mayor of LA literally got on the TV and said, you don't have to pay rent this month. And so with that mentality, that's what could cause the problem is everyone thinking, oh, we don't have to pay rent, right? In reality is almost everyone can go get unemployment, have almost 100% of their income replaced and then pay rent. But with that said, we're doing things like, hey, everyone who paid April rent in March, we gave them $50 gift card to a grocery store. We're waiving any and all online payment fees. We're doing additional drawings for paying early. We're doing lease renewals with no increases, especially if you do it, the earlier you do it, it will give you even more benefits. Everything's gone virtual, and I won't, I'm sure, that's what a lot of people are doing. So I'll stop at that point, but just a lot of those things, trying to help the residents, cut expenses, and then protect their income. And then maybe down the road, having to work with our lenders for forbearance.
Yeah, John Cohen, what are you guys doing?
I get to follow that up. But no, I think the only thing that we're not doing, Andrew touched on basically everything. I think everyone's going to be doing the same thing. We've put a big, we're trying to get in front of our tenants. We're working with them. We've reached out to them proactively and said, hey, we're in it together. I mean, you have rent, we have mortgages, but if you bring us your problems and they are COVID-19 related, we're going to work with you, whether it's a discount on your rent or you add it to the back end. But in addition, it's these people are hiring, these people are working together. So it's basically just been a, damage control. And, there are people coming out, and I saw someone posting on Facebook today, and governors and people, don't pay your bills, don't do this. And we're trying to tell people that, that's ridiculous. Your rent, we had tenants call us and say, if you charge us rent, we're going to sue you. It's illegal. And we're like, you still got to pay your bills, but we're here to work with you. Let me help you. Because if you guys don't pay, we're in a totally different situation and we're not going to be able to help you. So we've put a big pressure on, our on-sites, resident letters through the portal, everything's virtual, just saying, hey guys, we're here for you. You pay your rent early, we'll work with you. If you need some help in April, no problem. If you need them help in May, we're here for you. But we put a big, a lot of pressure on our teams to get out there and just help however they can with, tenant retention. And like Andrew said, just, mitigating expenses has been the biggest thing, working with vendors and, contractors and renovation projects, seeing if, hey, we'll pay you in full right now. Can you give us a discount? So anything we can do to control our expenses, including, applying for all the loans and, all that stuff. We're going through all that, whether we qualify or not, we'll see. But a big thing on working with tenants and showing that we're there for you. We took over a lot of super rough properties. So just over the last year to 6 months, even what we've done so far, the tenants have been so thankful that we've gotten the old owners out and we're in there now, that, thank God it happened that way, because now they're sitting there saying, wow, these guys really did care. They improved the property. They cleaned it up. They got rid of a lot of the trash. So I think tenants are, I've been surprised. It's April 1st. I was on calls all day, but, we're pleasantly surprised with the outcome so far with the prepayments. And, we're going to continue to work through that.
So one of the biggest fears we have is one of them is people can't pay, and that's a real thing. I think the bigger concern we have is that people won't pay. They'll just there was a 30 unit in Houston that was on CNN a couple days ago, and they all got together and basically declared that we're not going to pay rent, right? And so some of us, that's what I'm mostly concerned about. So Ellie, how do you assess the risk of our tenants essentially strategically defaulting on their rent?
Yeah, I think it's a very interesting question. And as a former lawyer, I basically, looked into the CARES Act. I didn't read all 800 plus pages, but the concerning part of it was basically the fact that even if someone did not lose their job, if they don't pay rent, you cannot evict them. And that goes for 120 days, which it depends, once tenants understand it, because some of them still think that only if they lose their jobs and they don't have to pay. But, to your question, I think when it comes to assessing the risk, it really depends on your prior relationship with your tenants and which area your investment is. Because I used to think, based on the 2008 crisis, that Class A are, not going to do very well because many people migrated from Class A to Class B and C. And a month ago, I thought that Class A is actually, it's a good investment now in this crisis, because you're basically going to have people that are, people that usually, live in a Class A apartment building. They have a very solid tenant profile. They're usually, they're making decent salary. They can work remotely. But then what happened was exactly the opposite, where you see this initiative to stop paying rents many times from those Class A tenants that have more access to information. So it just to show you that you cannot learn much from one crisis to another, because every financial crisis is very, very different. I've listened to all the different tactics on, protecting the cash flow and making sure that the income is stabilized as much as possible. I would add 2 more things to that in case, it's some of our listeners and the panelists would like to implement it. One is basically looking at this crisis and ask, what are the needs right now that we can, tap into? And one of the needs is to provide housing for traveling nurses. And so we are actually, we are using our model units that are furnished to basically reach out to nurses. And we have several links that we know where to go and post housing for traveling nurses, also on a, on a monthly basis, on a weekly basis, without any premiums. So that's one thing. I would say the other thing is, mainly make sure, like everyone else said, to renew the contract early on. But another way to do it is make sure that we can allow tenants to use the security deposits to pay their rents. But obviously, I still want to have, I want to be protected. And so we're working with a company that basically can replace those security deposits with an insurance. So let's say someone paid $500 as a security deposit. They can basically use the security deposit money to pay the rent in case they lost their job. but they will have to pay between $5 and $10 a month for at least a year for an insurance policy that would replace those security deposits. So this is just another idea of how we can help our tenants pay rent, on time.
Yeah, I love that. Brian, you've seen this before with SARS and the last recession. How are you responding to this for your properties?
Yeah, I've seen it several times. We saw it in Hurricane Harvey in Houston. Was kind of a similar example when the whole city was shut down and there was massive job losses and no evictions because the courts were damaged. So saw it then, saw it in the 2008 recession, obviously. And so we've kind of been through this a number of times before. And, we were kind of digging into the same old playbook on a lot of stuff. Essentially, we're doing almost all of the same stuff that all of the panelists have discussed before. I think only a couple of things I might add to that we're also doing. We are referring people to a program called Project Porch Light. It's a nonprofit agency run through Money Management International that provides counseling on financial matters, and it's landlord friendly. I mean, they understand the concept that the first thing you pay for is your housing, and then after that, then you have workouts for everything else. So there are workouts for student loan payments. There's workouts for car payments, credit card payments. There's a lot of other variety of forbearance that's out there available to the tenants. So, rent really is the last one they should stop paying. And, and some people are going to be hit by this really, really hard. But for the majority of people, what they have really is not an income problem, but a cash flow problem, at least in the areas where we own. So, thank God we don't own in California anymore. So I don't have to worry about having a bunch of units out there with $4,500 rents. I think, the highest rent that we have is probably around $1,400 or $1,500. So, with that size rent, the $1,200 checks that every individual is going to receive are easily covered. It's just a matter of when that money comes in. If they were laid off from their job, there's really good unemployment benefits. There's work share now that they can pay partial unemployment if your hours are cut. So it's just going to take time for that cash to get into their bank accounts. So we can help solve the cash flow problem by allowing people to postpone some of their rent, and maybe we amortize any missed amounts over the course of the next 6 months. Or maybe it's due the following month, depending upon what their ability to pay is. So I'm not all that concerned about most people's ability to pay. I'm more concerned about their willingness to pay. Right. So what we're doing is we're taking a bit of a different approach, almost the opposite of what Andrew is doing. Andrew is using the lure of, if you pay, you get a $50 grocery card or a $50 gift card or whatever, some kind of a reward if you pay. And we're actually kind of taking the opposite approach, where if you come to us ahead of time, and let's say you've been historically current, and you come to us and say, we have an issue, I lost my job, I won't have my helicopter money check for 3 more weeks, and I won't have my unemployment check for 2 more weeks, I just need time. We're giving them a $50 gift card to the grocery store to say, here's some money to go buy groceries. Hopefully this will tide you over. We'll work with you. Come back in 2 weeks and let us know how things are going. The objective here is really, it's partly just being human and trying to help them out in their situation when they're tight. The other part is partly psychological, where it's like when they come to the point where they have to decide which bills to pay, and that's really what people are going to come to this decision point where they have to decide what to do. Hopefully we'll be a couple rungs higher on the ladder because they'll remember that we took care of them in their time of need. That may or may not prove out to be true, but we're trying that among just the other counseling and other things that you mentioned. I think that's pretty much it. Most of what else we're doing, you guys have already covered. One comment about the payroll protection loans. I saw a question come up in the chat box about it. Somebody asked what it was, and it's a loan given by the Small Business Administration that basically they'll loan any business 2.5 times their monthly payroll, and if they keep their employees, they can use that money to pay payroll, utilities, loan payments, and a variety of other things. We're definitely applying for that, and I think it's going to benefit us because we manage our own property. So all the on-site staff are our employees. I don't know how it's going to work out if you have third-party management, because even though you're paying the freight for those folks, they're not actually your employees. So, I think the jury is still out on, how applicable that's going to be. But for us, I think it'll work out. Those loans are forgiven as long as you keep the employees on staff. So if we take a bit of a haircut in income, then I think, we're still going to come out okay, because the PPP will help absorb some of those payroll costs, and maybe we can grant even some partial forgiveness for people that were really having a tough time. So those programs kind of just help, buy people time. That's really what we're trying to do.
Yeah.
One more thing, just last comment. Lease renewals and retention is really critical. We're focusing a lot of efforts on renewing people with no increase. We're doing 0 rent increases for renewals, and doing all we can to save move outs, and which ultimately results in saving turnover costs. So I think, that's one more thing that's really important right now.
Well, it's great. We left nothing for other two panelists, which is Reed and Drew. But Reed, hey, what's your perspective on this thing?
Hey, mate. Look, I think at the end of the day, it's keeping the hysteria at a manageable rate. I think we're all got to remember that the only positive I see right now is this is happening across the world. Multifamily properties in other parts of the world are having the exact same problems. People paying rent in Australia, in Europe, in the United Kingdom. I'd be a lot more concerned if it was just America. So that there's some silver lining there, that we're all in this together. And I echo all the things that people have been saying about the different ways to help, and everyone's going to have their own different special sauce to it to try and be there for the tenants. But at the end of the day, per Brian's point, is like, who's at top of mind? But food and shelter are going to be the two most things that people are going to want to pay for off the top of the bat. Self-storage, I don't know if your self-storage bill is going to get paid this month. There's other asset classes out there that might be a little bit lagging, that we won't get into that because we're not self-storage operators. But what I'm seeing is that at the end of the day, we're trying to mitigate the expenses, trying to look at these loans, but also just trying to control the hysteria around the whole thing, making sure there's good information on site to the tenants, and it's not just hearsay and looking at the consistent news cycle that is just a bunch of fear. So I think in general, from a high level point of view, trying to make things be a bit more understandable, human level. From an employee point of view, from our payroll situation, we are cutting back. One thing that we are doing, we had a couple of, actually, just from specifically to our portfolio, we had a couple of maintenance tech that positions we needed to fill. Given the slowdown of actual only critical work orders that we're doing, we're actually now starting to share maintenance tech around our portfolio, which helps keep people employed for longer rather than having to reduce everyone's hours, which is also something to do just more from a human level to keep our folks. We don't have to fire them, or we don't have to let them go or reduce their hours. So other little different ways of managing the current staff we have in the portfolio to ensure that everyone has a full paycheck for their own personal house, and they can keep their roof over their head and their food on their table. So yeah.
So people listening to this, if they're owning property, these things that we're talking about are a great way to kind of mitigate some of these risks. There's also passive investors who may be listening to this as well, and they might be kind of biting their nails going, oh my gosh, am I going to lose all my money in this thing? Are we going to hell in the handbasket? Are we going to lose these properties, whatever, in foreclosure, possibly? And Drew, kind of put a perspective on that. I mean, from an investor's viewpoint, how at risk is their investment through all this?
I mean, maybe your IRR has been dinged, right? It was going to be 17 and now it's 14 or something along those lines. But unless your property was already being run poorly, COVID is not going to drive it into bankruptcy. I don't think. I mean, we got $2 trillion in stimulus. This is housing is a non-discretionary asset, and most of us are in non-discretionary types of housing. We're not in the Class A's that Ellie were referring to. So I don't think that's the case, right? And I was talking to a friend recently. All of us took a 30% paper loss on our stock portfolio. So if we had $100,000 in the market, we're now down to 70,000. Everyone, like, you can look online every hour and see how much money you've lost that hour. And one of the great things about this asset class is I still have a building that's 100% occupied, and it's still providing the same valuable good and service to my tenants that it was before COVID-19. And it's going to still give me a cash distribution right next month. And there's a beauty to the fact that, unlike the stock market, we can't check the value of our asset every hour. It provides some sort of sanity. And so I think for the investor out there, for the passive investor, it's nice to just not, worry yourself sick about the investment every hour looking at the stock value. These are phenomenal asset classes throughout time, throughout recessions, and they will continue to be. Will this have some mathematical impact upon your investment? Probably, but is it still a phenomenal asset class with great long-term macroeconomic trends? It absolutely is. So our thesis for why we do this is unchanged.
Yeah, we talked to one of the sellers of the property. What was his name? An old guy, like 80 years old.
Yeah,
Bob, Dave, whatever. And we're sitting there jamming with this guy, and it was like story hour with Uncle Bob, who owns like 10,000 units, and he was selling us like one of his little crumbs. And it was fascinating, I asked him the question, how did you fare in the last recession? And he goes on about his stock portfolio and the cash management and the stops and the hedging he did. And he went on for like 10 minutes. I said, Bob, that's great, Bob, but how did your freaking portfolio do? He was like, oh, that was fine. He was like, it was like a non-event in his mind was a recession. But Brian, you have some perspective on this. You've been through you went through Houston and SARS and things of that nature. What is your perspective on the impact to investors, short, medium, long term?
Well, I think a lot of it depends on who they're invested with, who is in charge of the deal, and how that deal is capitalized. That's really what it's going to come down to. If you're invested with a group that is using fairly low leverage, longer term debt, has a solid business plan, and is well capitalized and raised plenty of reserves, you're probably going to be just fine. You're going to have a hit to your cash flow. I would expect that most, if not all, sponsors are going to be halting distributions at the next quarterly distribution cycle. If nothing else, just to hoard cash because of the unknowns. So I think that's probably going to become fairly universal. If it's not, they should. But if you're invested with someone that barely was able to raise, just the dollars needed to close, and they're using a high leverage bridge loan that's probably coming due fairly soon, that maybe they had a 1-to-1 debt coverage ratio going in because they were counting on renovations to carry them, and all their renovation money is tied up in the loan where they can't get it released from the lender. They may have a tougher go, because a lot of the bridge lenders may not be as willing to work with you as Fannie and Freddie are granting some extensions on payments, some forbearance on payments if you need it. Nobody knows yet what the bridge lenders are going to do or the CMBS lenders are going to do. And if they won't cut you slack and you have no reserves and your loan's coming due or your cash flow gets compromised by 25%, you could find yourself in foreclosure. So I could see some either undercapitalized or inexperienced sponsors get caught off guard by this, and those investors could see a partial or total loss. I hope that doesn't happen, but I would expect it probably will to a certain extent among some groups. But I think by and large, most people will come out of this okay. You just won't see the returns that you were expecting. I've been saying for a while, when something like this happens, you switch from offense to defense. Forget about unit renovations and rent increases and all the things that we, had in the shiny, glossy brochure that we hoped to see come to fruition if everything went according to plan is out the window. Now it's about hoarding cash. It's about surviving to get to the other side, because if I don't lose your money, you'll have it here to invest with me again. So that's really job number one. If it makes you money, then consider that a bonus. The one thing we have that's going to help us in this case is hopefully this is going to be relatively short-lived. I think it's going to be longer than a lot of people think. I mean, there's people out there saying it's going to be a V-shaped recovery. I don't buy it. I think we're going to see, 1 to 2 years of zero to low rent growth. We're going to see reduced economic occupancies across the board. It's going to take a while to recover from this in a lot of markets, and people need to be ready for that. The landscape has changed.
Yeah. I want to talk about outlook. I want to get perspective on that. I mean, for now, what kind of effect are you seeing on the capital markets, right? So on lending, both Fannie, Freddie, JC, I'm going to call on you. What are you seeing? What are you seeing the effect, and what do you think is going to happen of capital markets, both for us owning property, but also possibly for those who are essentially buying property? What are you seeing happening out there? I'd like to get your perspective on that.
Yeah, we've gotten, I think everybody here, all the lenders we've worked with, they've been sending out their updates, and you've seen it. We had a deal mid-closing that the lender was supposed to close on the 30th of March, and they actually said, hey, let's wait till mid-April, end of April. They want to see what's going to happen with the tenants. So, on the capital side, and you've seen it, CMBS lending, bridge lending, some of that stuff has taken a backseat. I think there's more lenders that are, the people that are pushing out there will still do it. They may be a little bit more predatory, taking advantage of some people that may not know what they're doing. But the agency stuff, interest reserves are going to go up. Tax insurance reserves are going to go up. The debt service coverage ratios, they're going to go up. The LTVs are going to go down. And we've seen it. We've seen it just from a standpoint of, all the emails and the updates. And, when you're going into new deals, think about it this way. But in addition to that, interest rates are down, but spreads are wider. So interest rates haven't come down the way that, they were 4 weeks ago or 6 weeks ago when you could borrow money, 10-year money at 3.5%. We refinanced the deal for about a month ago at like a 3.7 rate. That rate today is mid fours, if not higher, give or take. But I think it was the slap in the face or the punch in the face that, unfortunately had to happen to, because there was some crazy and, for lack of a better term, crazy shit going on. Just lenders basically just giving people money and, 5 sponsors coming together to do a deal. And those deals, were getting done because it was easy. I have lender friends that would call me, and there were people calling up saying, what's a cap rate? Is this a good deal? Asking the lender that opinion. And those deals were getting funded and closed. So I think that this is the thing that, maybe it's the straw that broke the camel's back, where just so it's not like 2007 to 2009 where the lenders were just giving anyone loans, and it wasn't on the commercial side as much as the residential and all that. But I think this is the thing. Is that, wait a second, guys, let's pump the brakes a little bit. Let's vet the sponsors a little bit harder, make sure they have the cash. One thing that we do, and as Brian mentioned, we are going into our deals extremely well capitalized. And I think everybody here does that. And that's something that I know sponsors that are like, oh, we only need $1 million to close, and we're going to raise the CapEx, over the next 8 months. And that to me is always scary. Listen, I get it. It makes the IRR better. And if you have the ability to do it, you do it. But if the money's not there in the future and you need it, it hurts. And I think lenders are going to, open their eyes up a little bit more to that. And, they're going to cut back a little bit. And we've already spoken to, a ton of the lenders we've worked with, hey, what, going forward, what do you want to see and all that stuff. And we've used that, propaganda and that marketing, to sellers and saying, hey guys, times have changed. Your deals are not the same. I even heard one lender, I think he did a report on it, talking about, appraisers and cap rates going up a point. They want to be extra safe. And I think that's just going to inevitably put a little bit of a strain on the market where, maybe it's not as readily available as it was, or it's not going to be as much as it once was.
So we're seeing lenders require 12 plus, months of reserves suddenly. The LTV is going from 80 down to 75%, right? So that obviously is going to change prices and valuation. Ellie, what kind of effect are you seeing from sellers? How are sellers reacting, and is that creating a buying opportunity for you, or do you feel like it's kind of like hey, let's just see what happens?
Yeah, so I think it's very interesting when it comes to sellers. We definitely see many more off-market deals right now. We actually have a lot on our plate right now. A lot of sellers understand that it's going to work against them if they're going to take the deal through the the usual 6 to 9 months process if they market the deal. Some of them are freaked out because of this environment, and they just want to sell. And so we see that. On the other hand, we also see some sellers that they're not willing to reduce the price. And obviously there is a risk, even though it might not last for 3 or 2 years, but there is a risk, and this risk should be quantified to some extent, and that should be baked into the price, because the price, there's always a risk, and you assess it to the best that of your ability. And this is something we've never dealt with before, so we're unsure even how to quantify it. I think probably in 45 days from now, we'll have financials of April and May, and we'll be able to have a bit more clarity, because we can all we can do is guess. We're talking right now, it's April 1st. The day is not over yet. We don't know how many tenants actually paid and how many we're going to put on the payment plan. But we definitely see a shift in the market. The market has changed overnight from a seller's market to a buyer's market. I get a lot of emails from brokers saying, what is the price you're willing to pay? The seller is open to negotiate. So we definitely see something we haven't seen, in years.
Yeah.
And you asked me also the second part of your question about an opportunity. I think a deal can be an opportunity as long as you're able to assess the risk and the unknown. If you cannot assess the risk, if you cannot assess the unknown, how would you know if the price cut is enough to cover for the loss in income in the next 12 months? You just don't know. So I see a lot of fear from investors out there. And I always say, in any investment, there should be no feelings, no emotions. This is a deal. So you shouldn't be afraid or have any fear involved with, making a deal or joining a syndicator. The same way that you shouldn't be excited about a deal because the building is beautiful. These are two emotions, and they should be out of, take these emotions out of the equation and focus on the numbers. Does it make sense? The income makes sense, and does the price make sense? And understand, how the property actually performed during, April and May, which are, I hope these are going to be the only 2 hard months, but nobody can really know.
Never know. It's interesting. I mean, like you said, it changed overnight. I mean, we had a deal where we had to put deposit EMD hard, and we're like, oh, I don't know if we should do that. And all these deals are, hard money down, and all of a sudden evaporated. Sellers are no longer insisting on hard money down. And I was like, wow, that's amazing. Reed, what are you seeing out there with your sellers and some of the deals you're pursuing? Because one of the things is like we're always so frustrated about our inability for these deals to pencil, and I feel like it's shifting and changing. What are you seeing out there?
Yeah, so I think two things is one thing. How do we all see this coming? Is probably a big thing. We didn't. It's a very weird disease that came out of China, and so it wasn't a systemic issue, but we're not going to get into whether this is covering up systemic issues in regards to the debt market. So we'll put that to one side. But in terms of the selling and the buying side, I think it's going to be interesting. We were definitely gearing up to sell a couple of deals this year. And how we're talking with our brokers throughout the week. How do we go moving forward to discount the deal or write off the rent roll that's going to be now baked and we're going to have a hit to it? How do you go show that come June, July, August, coming to the end of Q2, Q3, Q4? And what does that mean as a seller? Now, as a buyer, I definitely want to see a discount. But as a seller, do I want to see that discount? Coming to the fact that, okay, March financials were great. Okay, April, May, June, they might be a bit discounted. We have to put them to one side, or we have to factor them up or factor them down. I've definitely seen 3 or 4 deals we've offered on, or we've been working on since February, where the whisper price when you first walked the deal was at $40 million. And now all of a sudden they'll take 33. You're like, well, that's great. So it's a little bit of, it's going to be interesting to see both from a seller's point of view and a buyer's point of view. Buying point of view, I think there's going to be a great opportunity. From a seller's point of view, it's going to be a lot harder. And how are you going to discount your rent roll, your P&L, and all that sort of stuff, and how you're going to sell that to the next buyer. And I think there's going to be a bit of a standoff period where new buyers are going to say, well, we're going to want you to discount it, and we're going to want you to sell it to us based on the current financials. And the sellers, myself included, and probably some of the other people on this call, that we have assets we want to sell, we're going to have this sort of standoff for a period of time, and it's going to come. It'll be time that will pass, and then someone will have to. You'll come and meet somewhere in the middle. Whether that happens quickly or whether that happens over a period of time, it really depends on how much money you have on hand, and if the asset is cash flowing in order to make cash distributions. So, yeah.
Drew Niffen, from a passive investing standpoint, right? And we know it from some people. No one's doing anything right now. Everyone's like, sucking their thumb in the corner, waiting to see what's going to happen. But what should the passive investor be doing or thinking right now in the short term? Should they invest? Should they sit tight? I mean, what do you think?
Well, one of the beauties is that you don't have much of a choice, right? I mean, going back to what I was saying before, if you're a passive investor in the stock market, you sell because you're scared. Right now, you're sort of locked into for a 5-year liquid investment or illiquid investment. So, I think as everyone was saying here, I think that there are good buying opportunities. We were on a acquisitions call this morning where the seller just knocked about $10K off every unit. They're like,
per unit, it was like 80,000 or 80,000 per unit or 90. I don't know. Like overnight. I'll take 10 less.
Right. And of course the financing terms are way better, right? We can put in a financing contingency or things like that, maybe not earnest money. So the point is there are better buying opportunities now than there was before, which means for the passive investor, there is more opportunities to invest in quality deals. And I'd say the passive investor is probably like, I just lost 30% in the market. So maybe if I have a 10% IRR, that is sounding really good in comparison to what your alternatives are for your dollar. So for the passive investor, I think if you're already invested, well, hopefully you chose a good operator because you're saddled up with them for the ride, for the duration of the investment. And if you're looking to put money to work, then it's a matter of doing your due diligence on your operator. And importantly, as I think it was Cushman was talking about, or maybe it was Brian, how well capitalized are they? And also, like, what financing product are they choosing to use? If it's a 24-month expiration, then you got a gun to your head to sell at 24 months. Whereas if there are extensions and if there is not yield maintenance, then the operator can choose their time to sell as opposed to being having their selling time dictated by their debt product.
So I want to pull out the crystal ball. We're going to do a little fire round here before we take some questions from the audience, and our lovely Kate is going to help us with that. But I want to get your perspective on the crystal ball. What do you expect? Short term, medium term, long term? Brian, go. I'm sorry. Time's up. We'll go on to our next contestant. Brian, what do you think, man? I always value your perspective because you've been doing this for a long time. You do so much crap, and you really study the markets. So I'd love to see what you think about that.
Well, I think short term, obviously, we're going to all feel a little bit of pain. I think transaction velocity is going to grind to near zero. The only sellers that are going to be in the market are going to be those that have to sell. Anybody that just wants to sell will just wait. We were going to sell 1,000 units this year. We closed on 276, and then I had one deal fall out, and I had another we were just taking offers on when the whole thing hit the fan, and we're just going to press pause on that one for right now. Because we're not under any pressure to sell any asset. And that's what's important about being well capitalized and having the proper debt structure. You can wait this kind of thing out. So I know a lot of people have said, oh, there's going to be the great buying opportunity. Real estate's going to be 50% off. I doubt it. There might be a few deals that are really good that come across from people who just have to sell for whatever reason. So you might see some of that in the short term, but by and large, transaction velocity is going to grind to a halt until we can all learn how to quantify the future. Right now, we're all trying to figure out what is physical and economic occupancy, what is rent growth, and what is that going to look like, 6 months and a year and 2 years from now. So until we can get a better handle on that, most of us are waiting. I'm under no pressure to buy anything either, so we're not buying anything right now unless something really incredible came along. In the midterm, I think you'll see transaction velocities will slowly ramp up. I think that incomes are going to take a hit for a while simply because it's going to take a while for these jobs to rebuild. I mean, the things that drive multifamily real estate more than anything else is income growth, job growth, and population growth. And there's been a little bit of income growth in some sectors because, you know, they're like grocery stores have been giving people raises for hazard pay, but that might disappear. Job growth, we're in way negative right now, but that will come back. And population growth, people aren't really moving around. So not right now. They might have scuttled their plans to move, and so that's going to be slow. Some employment sectors are going to be slow to ramp back up. I mean, people aren't just going to all of a sudden start flooding onto airplanes and hotels as soon as they lift all the shelter in place orders. It's going to take a while for people to feel comfortable traveling again and going to restaurants, and maybe they don't have the money for that vacation. So a lot of that's going to take time to come back. And markets like Las Vegas, for example, may have a really steep road to recovery because they got hit so hard and they're so travel and conference and event focused that, you know, events have been canceled out 6 to 8 months out. And you know, some people are going to virtual events and there might not be as many events. So all of those things are going to have a role to play in the recovery. And then in the long term, we're going to be just fine. I mean, you know, 2 years from now, we'll kind of look back on this and chuckle about how we survived, you know, the COVID-19 collapse, and everybody on this call will, in the subsequent recessionary time, will be talking about the experience they had in the moment we're experiencing right now. I think those of us who are here that are, you know, are on this call are all doing it right, and we're well capitalized and well financed, which means we'll survive, and we'll be here to live another day and tell all kinds of cool stories and grow as a result, because there'll be a lot of guys that do what we do that won't survive this, and you know, we'll be there to fill up that void.
We'll be buying all their stuff. Ellie, what's your crystal ball?
So I think, you know, in a short term, there will be pain. I used to think it's going to be a V shape. That was a few weeks ago. I don't think so anymore. I think we're looking at a U shape. So, you know, pretty much like similar to what was said here before, I think it's going to take time for jobs to restore. I think it's interesting to see if you can at least see where your properties are and see how much the unemployment changed, and basically what portion of the workforce is actually being employed by small businesses. That would give you a good insight into how much, you know, what impact to expect from your property. And that's what we were looking at, all the reports to see where our properties are located. So I think probably in the next 30 to 90 days, we're going to feel the pain the most. People being laid off, higher delinquencies probably. And then I think in the midterm, we're going to see a slow, rebound. I think in the long term, we're going to be just fine. And I really like, you know, the flexibility of not being forced to sell now, which is why every time we buy a property, let's say we plan to hold it for 5 years, we take a loan for 7 or 10 years. So if a loan is due, let's say in a month from now, I can still hold the property for 2 more years or 1 more year, and I'm not forced to sell now. So just, you know, being very, conservative especially with around the debt structure and the terms that can really help you kind of weather the storm. So I think we're going to be just fine. And again, if you're well capitalized, you might not see 8% cash on cash, this year, but if you're going to see 6, I would say you were doing a good job, and hopefully in a year to 2 years from now, we'll be able to compensate for the decrease in returns.
Well, even if you take zero cash on cash, you're not seeing a 33% reduction in capital, which is a plus also. JC, what do you see ahead?
I agree. I think, the immediate impact is going to suck, over the next 30 to 120 days, 90 days. We don't know, right? No one knows. Early on, I was on the opinion of, everyone nowadays has short-term memory loss, we'll be bounced back by June. I don't think that's the case anymore. I think that, with all the job loss and the continued job loss, and now more states, there's, I think 45 states are on shelter in place. I tell people multifamily is about jobs. So, with all that stuff going away, it's going to take some time to ramp up. So I think the short-term short term is going to be painful, right? We're all going to get kicked in the teeth. It's a, it's a 12-round boxing match right now. And, we're in round one and, we got knocked to our knees, but we're going to get back up. Middle, I'm not worried about it. I think it'll be slow getting back to where it is. And as Brian said, 2 years from now, we'll all be laughing and talking about COVID-19. We all weathered the storm. I'm happy I didn't get involved in real estate, 3 months ago, and I've been doing it for a little bit because I got a little bit of a springboard to, try and see what this is like compared to some other times. So I think short term will be, rough. Middle will be, everyone will be rocking and rolling, and then 2 years from now it's going to be, in the past.
I think it's going to be rough in the short term for owning property. I think it's going to rattle loose some buying opportunity. I am absolutely convinced of that. And anyone who's well capitalized, like I know everyone in this call is, we're gonna take advantage of that situation for sure.
I say all the time, a deal's a deal, right?
Oh, yeah.
A deal's a deal.
I mean, look, fundamentals, right? Fundamentals are fundamentals. And we know that maybe in the short term they may be whacked, but in the medium to long term, we know the fundamentals are there. So if we can pick up a deal right now for $10,000 less than 5 days ago, okay, it probably is it may be a good deal. Plus, we're not putting down hard money, and we still have 12 months reserve that we have to raise capital for, and the numbers still work. I'm in, right? I'm in because the risk is off the table. Cushman, what do you think? What do you see coming?
Yeah, for short term, I would echo what everyone else says. It's going to be painful. How painful it is depends on how good of an operator you are and how proactive you've been, and to a large degree, kind of what your tenant base is like. So yeah, short term is going to be painful. I will say one big ray of hope in this is in 2007 and 2008, if you went to your lender, their attitude was screw you. Whereas now the lenders are proactive and they're coming to everyone and say, oh, hey, let's do forbearance. Let's try to work this out, right? Because they don't want to end up owning 90% of the property in the United States in the next 6 months. So the short term is going to be painful no matter what. Midterm, I agree with Ellie. I think this is more of a U-shaped deal where we drop down, we bottom out, and it's going to be a long, slow recovery. I think COVID is going to be around for 12, 18, 24 months before we really get a handle on it. I think this is going to come in waves. And while, I'll skip to long-term and then come back. Long-term, we're going to look back on this as a wealth building opportunity, right? I mean, almost everyone on this call and everyone out there is like, oh, I can't get a good deal. Well, guess what? Good deals are going to come. They're going to come from the people who unfortunately aren't good operators, who aren't well capitalized, who aren't getting ahead of this. And they're just going to kind of all of a sudden wake up 3 months from now and go, oh, wait, I don't have any income. What's going on? How do I fix this? Too late, right? That's going to provide opportunities for those who are well capitalized. And for someone who's like just beginning and who hasn't even gotten into this is what you've been waiting for, right? Because now you can take the next 3 to 6 months, get an education, get capitalized, and be ready to jump on opportunities. I would add a little bit of, or recommend a little bit of caution though in the midterm, and not to be too anxious to jump on deals. Because when I go back to 2007 and 2008, April 2007, New Century failed in California. That was the shot across the bow, right? By the end of the year, the stock market started to collapse. The Fed was cutting rates, and then in March of 2009, the stock market bottoms at less than half of what it was. And I saw people buy apartments early on, or any real estate early on, thinking they were getting a great deal a couple months in. And then a year later, they were foreclosed on and the property was up for sale for even less, right? So, getting into the emotions, don't be fearful, but also don't get too excited. And don't, when a market's going up, it's better to sell a day early than to sell a day late. But when it's going down, it's better to buy a day late than to buy a day early, right? So, when you look at real estate moves slow, like Drew was saying, you can log onto your stock account and see that you lost 20% yesterday. Well, real estate, it takes a long time to kind of work through. I see deals starting to really show up 6, 9, and 12 months down the road. Again, going back to the last recession, when I look at some of the amazing deals that we bought, it was in 2010, 11, and 12, not 1 and 2 months into the crash. And so again, long term, we start, 3, 4, 5, 10 years down the road, most of us are going to look back and go, man, that was tough, but wow, it was a wealth building opportunity once we got through it. And so that's how I'm looking at this is, okay, the next few months are going to be really difficult, but man, surviving this is going to make us so much better operators. You get through this, you're going to be able to handle anything, especially when the times are good. And then when things bottom out and we start improving and jobs come back and things normalize, the wealth opportunities are going to be huge. So that's kind of how we're looking at it.
So before we call on Reed and Drew here, I think we've kind of beat this one to death here. I think the consensus is there's going to be some pain short term. Long term, it's going to be great, and it's going to rattle loose some buying opportunities. So let's take some questions, and then we'll call on Reed and Drew to answer those questions for us. Kate, what do you got for us?
All right. Let's see. Where we want to go? Facebook group. Let's see. To all the panelists, are we learning a new way or angle to stress test acquisitions with the current environment?
Reed, what do you think?
Yes, 100%. I think one thing that we've always done is overraised for operating accounts, overraised for CapEx accounts historically. I think you're going to see a lot more people doing that. People sort of joked at us when we did it 2 or 3, 4 years ago. It obviously reduces the IRR, but you have more capital on hand for these rainy day events. You're going to see a lot more of that happening now, I think, and a lot more requirements from the banks to have that happen. So I think it's going to force us to be better. So, yeah.
Yeah, and there's a question from Mauricio on the Zoom here. Is I got my first offer accepted. Seller agreed to extend due diligence from 30 to 60 days, accepted financing contingency. Is there anything else I should try and negotiate before signing the PA? So
yes.
What do you think, Reed?
You got to get it. You got to get into the units. So don't be signing any PSAs if you haven't got into at least 50% of the units. I wouldn't be going down. Like, that's the biggest thing now. So if everyone's still shelter in place and you're buying in a state or a city that is shelter in place, don't be. Oh, we're just going to the vacant units and that's it. No, you want to be seeing at least 50% of the units before you sign anything.
The only thing I can say about that is one of the things that he did is he basically mitigated the risk. So we don't have hard EMD from day one. That's a major risk gone. We've never had financing contingencies. That's insane. Like I can't remember a way we did not have, but we had financing contingencies. Now sellers are agreeing to financing contingencies. That's great. So and you're extending the diligence from 30 to 60 days, which is important because you have logistical problems of lenders being actually to fly to the property, right? Like actually getting there is going to be a problem. So if you can mitigate your risk in that way, I think it's a great way to get in the deal. And 2-3 months from now, if you have a 69-day due diligence period, it really gives you flexibility to get out for almost any reason. Again, you got to pay attention to the retrading on these things. But I think we can get into deals by mitigating our risk in a proper way. And that's kind of what I like about this. Kate, what other questions do we have here? Maybe for Drew Niffen, who looks like he's ready for a question.
With the secondary market frozen, how would you expect banks to hold their own paper to capitalize on the commercial loan demand? Historically speaking, what red flags are there for predatory lending from community banks, credit unions, when they are the only game in town for small multis titled in LLCs outside of HML?
Well, that's a lot of words in a series.
Let me dust off my economics PhD there. So like I know we have coaching students. We have people that have done deals with community banks. You get higher interest rates. Sometimes the loans are recourse to you individually. You get 25-year amortizations, but you usually don't have any prepayment, penalties. And if they're the only game in town, then God bless them. Let them charge their rates and see if you can make a deal. Like I don't have any problem with them doing that. That doesn't feel predatory to me at all. Give me another part of the question, Kate? Something about the secondary markets being closed and banks holding the loans on their balance sheets.
Mm-hmm. What red flags are there for predatory lending?
I'm not sure if I understand what that question would be. I think I would just
okay.
Yeah, I don't know.
We have lots of questions. Let's move on.
Let's keep going.
How about when underwriting a new deal, what vacancy factor would you use and how would you adjust the cap rate for market risk?
Well, this is what Brian said a minute ago. It's almost hard to buy a deal because you don't know what the numbers are. You don't know, is the fallout gonna, like we got on some phone calls with our on-site managers just to get April 1st data on collections and how many tenants are, turning in letters saying they lost their jobs because of COVID-19. But all that is soft anecdotes. We really don't have data. And so it's pretty hard to underwrite right now, which is what Brian said, which is absolutely true. So do you increase your vacancy by 5% or 15%? You can make an argument for either one, and the consequence of that decision are monumental as far as the numbers. So the short answer is there's not good information on how much to change your vacancy rates by, or your rent growth numbers by. It's hard for us to know right now.
I would just add to that and say that it's going to be very difficult to underestimate what that performance is going to look like. I mean, it's like if you think that it's going to be 8% vacancy and you decided to use 15% vacancy, you could still be surprised and find that it's 20% economic vacancy. So I don't think that you want to be very aggressive right now. At least I sure wouldn't be.
And I think to your point you've made before, Brian, on the year-on-year rental growth, that's going to take a massive hit from market to market. And again, we won't know that data straight away. So I'd be looking very carefully at your year-on-year growth as you model this, as you model out new deals for 5, 7, 10 years time.
Mm-hmm. Mm-hmm. Yeah.
Agreed.
Okay, what else we got?
Yeah.
There's a couple questions here about student housing. Anybody have any comments about that before I would ask any of those questions?
We have one student deal that schools are closed, kids are gone. There's parent guarantees in the leases. We're on the opinion the parents aren't going to let their kids' credit go to shit, and so they'll pay. In addition to that, it's outside of Nashville, so we're reaching out to hospitals and stuff like that if they need extra beds. If the building's vacant, we have already prefab rooms. So we've already spoken to some people saying, hey, if you need an extra, it's 72 units, and with 155 beds. So we're trying to turn lemons into lemonade because of the situation. But that's our one student deal. It's a local community bank. They've been amazing to work with so far. He called us and said, hey, no payments for 3 months. We understand that, it's different. So we're that's the one deal we have, and we're going to see how it shakes out. But other than that, I think luckily, the time that we're at, school year was ending. So if you did year leases, maybe have a little bit of a higher vacancy. If you're doing just like semester by semester leases, you were going to be vacant, coming up here in the next 30 days anyway. So, you might skate through it, because I do believe by August and September of next year, schools will be open and kids will be back and they'll need a place to live. So I think student housing is going to, it should be okay in the grand scheme of things, pending, you have the parental guarantees and, you're making sure that, all the stuff that you would qualify a tenant with. So we feel really good about it. We actually, are not worried about that deal at all.
Awesome. So the next question I have, and Michael, I'm not sure who you're throwing this one to, but do you see the stock market woes helping or hurting our ability to raise money? Should equity partners become more negotiable on pref and splits?
Hey, who wants to answer that? I'm sure you have some opinion about that. Brian looks like
I'll take this one.
Ellie and Brian will take this one.
So I think, again, it's pretty early to know. On one hand, you're going to have a lot of investors that just lost a bunch of money in the stock market, so they're not going to be as liquid. On the other hand, some more capitalized investors are probably going to look at the stock market and say, hey, I just lost $500,000 or $200,000, whatever it is. I feel more comfortable investing in multifamily. So I actually have, it's kind of a mixed bag of approaches. I have investors that said, I'm going to wait on the sidelines. And I have investors that reached out and actively asked me, do you have a deal? We have capital. We need to deploy it. We don't want to put it in a stock market. So I think it's kind of, it depends on your investor, database, kind of the mix of where they come from, how well capitalized they are. And to the second part of the question about GP-LP split, I think, I don't know yet, but I think the main thing is what we're focusing on right now is that the deal fundamentals are working. and once the deal is a solid deal, so there's a project return, and then there's the passive investors return. So if the project returns are pretty solid, if the project, let's say you were the only person who buys the deal, and the project, the building is basically, let's say it's a 6% cash on cash or 7% cash on cash, that's the yield on average, then it doesn't matter how much you're going to change the split between LPs and GPs, it will not produce more than that 7%. So the main focus is on the project returns. I think it's a little bit too early to start playing around with GP LP split, but I would caution the investors that are listening to us, don't be tempted to go with a very lucrative equity split. It doesn't matter if it's 95-5, if the sponsor is not experienced, if the deal fundamentals are not solid, it doesn't matter. You're not gonna, you're more likely to not see your returns. So just focus, instead of the equity split and the fees, focus on the strength of and the track record of the sponsor. I think that's more important.
Yeah, Ellie's exactly right. And we, about a week and a half ago, I gave my VP of Investor Relations the task of reaching out to our investors. So we sent an email out to our investors, and I think within 3 hours, he had about 500 calls scheduled. And so we've literally been talking to all of our investors. And so far, the feedback that we're getting, about 80% of them are still interested in opportunities. I would say maybe 30 or 40% of them think, wow, this is the time I've been waiting for. But the rest of them are just, hey, if I was shown the right opportunity, I would invest in it. About 20% of them are saying, either one of two answers. No, I'm hoarding cash. I'm not doing anything. My money's in my mattress. Or they're saying, gosh, I saw the stock market fall, and I think there's some opportunities for me to invest in equities. And so I'm going to focus on that for a while. So, it's a mix across the board, but I'd say 80% still looking for real estate. And really quickly, I just want to double back to a question from a minute ago related to the local banks and their ability to lend. I just want to close the loop on that one. The issue is that banks originate loans, and if they get stuck with those loans on their balance sheet and they can't sell them to someone else, they don't have capital to lend. So what you're going to find is local banks may shut off multifamily lending completely, and you just won't see them making those loans. So that means that, before you could go to a local bank or a credit union, you chose the local bank because the credit union was more expensive. Now, since the credit union got no business, they have no loans on their books, but the bank is all stocked up. They pull out. So now the only one left is the credit union because they still have some dry powder left. So it means you're going to have to make a lot more phone calls. And if that doesn't pan out, you're going to have to look at hard money lenders and private lenders. And even they're going to have more restrictions than they previously would have. So the lending climate is going to shift out there quite a bit. And I just wanted to kind of close the loop on that one little piece of that question that was left unanswered.
Kate, we'll take one more massive question, and Andrew and Reed can answer that, I think. Oh, no, wait, Drew. I can't remember who. Was Andrew and Reed. What the heck? And then we'll...
I'm game.
It's so hard to pick one. There are
I know.
Great questions.
Make it good, Kate.
Oh my gosh. Well, now you have to give me a second.
Oh, so, all right, fine. How about this? Andrew and Reed. The average investor, either they've done a deal, they've invested in a deal, they haven't invested. What should we be doing right now?
Well, number one, educating. Two, don't get too like I said, too excited about, oh cool, this thing was 100 a unit and now it's 90 unit, because you know what, by the end of the year it might be 70 a unit. I'm not necessarily saying that's definitely going to happen, but there's a strong possibility of that. So now is the opportunities. Let's say you've got 2, 3, 4, 5 months to not buy a deal. That's when you get educated. That's when you line up your investors. That's when you call the people you talk to and say, look, we've been waiting for this for years. We haven't been able to get a great deal. They are coming. Are you going to be ready? Do I have your information? fill out my investor form, build that list, start looking at deals. If you haven't been doing that, start underwriting deals so that, the best way to spot a really good deal fast is to look at 1,000 that suck, right? And when you see that good one, you're going to know it. Develop your parameters. What kind of properties are you looking at? Is it 10 unit? Is it 100 unit? What markets? What kind of A, B, or C? Do all of that now so that when the really good deals do start to shake loose, you are ready to jump on it and capitalize. That's what that's what we're doing. And we've been doing this for 12 years is we're just trying to go through and just, everything we can do to lay the groundwork to really capitalize on the next up cycle that's going to start after this. And for a new investor, this is a perfect opportunity to do that exact same thing.
Yeah, that's right.
I will add to that we're all at the same starting gates right now, is that we're all confined to our homes. When we do get released, it's going to be, you've got to look at the markets that are going to have the quickest out of the gate. Like who's going to come back, what events, what concerts, what bars, what shops, retail, what spending is going to come back quickly, and what markets are those, and then focusing on those markets to then maybe look at deals to what Andrew Cushman was just saying, and continuing to underwrite deals in particular markets that you've chosen, but also understanding how your market that you have chosen is going to get out of the gate once we get these restrictions lifted. That's going to be really important because we won't be able to get back to normalcy if you're stuttering along and no one gets out and no one starts spending. So that's really important as well.
I want to thank all of you guys for
point.
being on this panel. I know your time is super valuable, and I thank you for sharing your unbelievable experience here on this interview as well. All right, so the consensus is we don't exactly know what's going to happen at this point, and we're making a variety of measures to protect ourselves against what might be. And at the same time, we're really going to try to serve our tenants by providing them with resources, what they can do to help themselves as well. So we agree that in the short term, it might be a little bumpy. In the medium term, we think that there will be buying opportunities in maybe 2 to 3 months. In fact, we're already seeing that right now. Long term, we're going to be just fine. And I think, I don't know who said it, a couple people said it, but I think this is where wealth is going to be created right now. In the next 3 to 6 months, that's exactly when that's going to happen. And like we said on the show in the very end, I think the time right now is really to take the time we have, the next, 1, 2, 3, whatever months, we have unprecedented scenario where we're at home a lot. We're not going to the office anymore. We're at home. We can't do anything really. So we have all this extra time. We have probably at least 2 hours a day that we're no longer doing anything with. Now, what are you going to do in that time? I would propose to you that the time to shift is right now. So if you're watching this on YouTube or you listen to it on your podcast player, think about right now is a time to shift from where you are now, where you wanted to be this time next year. Maybe you were making just slow progress against that. Now is the time to do that. Now is the time where you have the time and there's not imminent potential buying opportunities, and you got another 2 or 3 month runway to get that. So I propose to you that you use this time wisely. And we have a variety of resources for you to help you do that. Number one is we've opened up our Dealmaker Mastermind, especially since the situation right now. It was a little more exclusive and had requirements on how to get into that. We've kind of taken all those requirements out and just made it affordable, $49 a month to join our Dealmaker Mastermind. And you can find out more about that at themichaelblank.com/DMM for Dealmaker Mastermind. And it's really an online community. We have several hundred people in there who are super serious. We've had many deals come out of that. We've had companies coming out, joint ventures coming out of that. People finding deals, partnering with capital raisers partnering with deal finders, balance sheet guarantors. It's really a magical environment. Now, you also have access to our deal desk where you can submit deals to us and our lead sponsor partners as well. So it's a really, really unbelievably cool program. And like I said, we just opened it up because I want to encourage everyone to kind of take action and build their support network right now while we have the time. Ask questions, get your questions answered. That's all in Dealmaker Mastermind. We also have other opportunities. We have online training. We have the Ultimate Guide to Buying Apartment Buildings, which is our flagship online course. You can find about that all at themichaelblank.com/products and check that out. We have a syndicated deal analyzer to help you get started with analyzing deals and making offers. And if you value mentorship, we have arguably probably the best program on the planet. Our students are unbelievably successful because you're working one-on-one with a full-time syndicator, And the students who go through that really accelerate their goals. They do bigger deals much faster because you're working with a full-time syndicator who owns several hundred, possibly thousands of units. And these people are hard to find, let me tell you, these mentors. And we have them. We have some of the best, biggest multifamily syndicators that agree to mentor other people. So if you're interested in that, go to themichaelblank.com/mentor and schedule a free strategy session with us, and you can explore if there's a fit or not. So check out those resources. Again, we also have this podcast. If you're just joining us right now, binge watch all the episodes. We have the YouTube channel, and we're in social media, of course, as well. So hopefully you'll follow along and absorb as much as you can. Appreciate you guys. Catch you next time. Hey, and before you leave, make sure you subscribe to my channel below. We put out videos every single week, and you don't want to miss it. Also, if you haven't done so already, grab my free ebook here, okay? It's a secret to raising money to buy your first apartment building deal. It's a good one, so grab that. And hey, check out another video.